we have an estimated 5 to 7 trillion a year until 2030 that are needed to realize the SDGs worldwide, including investments into infrastructure, clean energy, water, sanitation, and agriculture. So blended finance, VC, impact, crowdfunding, environmentally or social market instruments such as green bonds are among some of the range of mechanisms designed to bridge this gap. The shift towards sustainable finance, which has evolved beyond socially responsibility investing to include asset management and ownership, has profound implications for investors and companies alike. So most of the most influential institutional investors are now at the forefront of adding environmental, social, and corporate governance standards to their criteria for capital allocation. We call these ESGs, just in case not everybody knows this. So I'm having a bit of a fan moment. I'm so excited about who we have on our panel. I would first love to introduce the Honorable Dame Elizabeth Corley. Elizabeth, you have such a long, wonderful history of accolades. Please forgive me if I'm not going to go through all of them, because I'd much rather hear you speak than rattle down all these incredible things that you've done in the past. But you're Vice Chair and formerly CEO and MD of Allianz Global Investors. You're a non-executive director at Pearson's, BAE, and Morgan Stanley. You've spent a lot of time actively involved in the investment community. You chaired the task force for the UK government on impact investing, and you now chair the Impact Investing Institute. And she's also a crime writer, but that's a fun fact for another time. The next gentleman actually is Mirjam. I'm having a bit of an issue because I can't see all the screens, so let's stick with the ladies first. Mirjam Staub-Bisang is CEO of BlackRock in Switzerland and also senior advisor to the BlackRock Sustainable Investing. Prior to that, she also has accolades of experience in sustainable investments and also asset management from private equity and so on and so forth. And then the gentleman in the round is Raffaello Cervigni. Raffaello is the lead environmental economist at the World Bank, and he's basically been with the World Bank for about 18 years or so. But I'd love to start with you, Elizabeth. Let's talk about your definition of sustainability or sustainable finance.
Well, thanks, Tanja, and it's a great pleasure to be here today. I hope you can see and hear me. Congratulations to the technicians who've been working so hard to make sure we're connected. It's quite an achievement in itself.
Yes.
So I think that the key point to make is that there are multiple definitions out there. This isn't my personal one. This is the one that is adopted by thousands of supporters of something called the Impact Management Project. And it's got the great advantage of being simple. It is an A, B, C of definitions. A is for avoiding. So if you think of a spectrum going from traditional capital markets right through to deep impact and philanthropy, you start your ESG journey by avoiding. You avoid or mitigate the risks that you think don't work. Many, many investors have done that for years. And as you said, there's a huge gap to funding the SDGs by 2030 and funding the innovation and technology we need. Avoidance does nothing to fund that gap on itself unless that capital is redirected at scale into the new technologies. And that just doesn't happen immediately. So the next thing investors and asset owners tend to do is think about how they can benefit, the B, how they can benefit in their investment decisions. So can they benefit communities, the planet, their multi-stakeholder capitalism, it's called these days, making sure you're thinking about all your stakeholders. It's a big step forward because it puts a sense of purpose at the center of strategy for investors and corporates. But it still on its own won't bridge that SDG gap we talked about. And that comes to the C, which is the direct contributions to the innovation, the mitigation and the development at scale and at pace of the technologies that we need for both planet and also people in terms of social justice.
Thank you very much for that. Mirjam, you know, when Larry Fink announced earlier this year that the firm would make investment decisions with entirely environmental and sustainable goals, that letter became fascinating and, you know, went around the world. I would love to see, I think you guys are the largest asset manager on the planet with like something around 7 trillion in investments. How do you channel sort of finance into impact opportunities?
Yes, thank you, Tanja. I can hear my voice. This is really amazing technology. I'm really impressed. Again, thank you for inviting me. Thank you for having me here. And thank you for this interesting question. Indeed, impact investing is a focus of BlackRock. It's not just sustainable investments, as Elizabeth defined it very well. We're really also looking at the impact end of the investment spectrum. And here, for us, the challenge is really to find impact investments at market returns, because as a fiduciary investor, we cannot sacrifice returns for impact. So what we do at BlackRock, we look at investment areas such as renewable infrastructure, where we are a very, very large investor, at green bonds. Green bonds, which finance sustainable infrastructure projects around the world. And we've been a very early investor in green bonds, and we see that as a very growing field with our investors. And we see a lot of in green bonds, and we support the growth of such investments. Another area which I personally find very interesting, and I believe is going to be a very important focus of the investment industry, are transition bonds. Transition bonds, which help brown companies transition to become greener and to actually finance that transition into a low carbon economy. So these are areas we're looking at, but again, challenge is always impact as market returns.
I want to switch to Raffaello, and let's get to the opinion of the World Bank, because I know you've got a very, we'll probably be talking a little bit about biodiversity, but I think something we're going to come back to later is it seems like this is going to need so much more capital than we're even thinking about, and the question is, are we doing enough? But Raffaello, let's hear from you, please.
All right, good afternoon, and I hope you can hear me okay. And again, I want to congratulate the technical team. This is the first kind of hybrid conference that I've attended to, part in person, part online. So this is great, and of course, very important topic for us. So I'd like to perhaps go back to the issue of the scope of this effort that we are carrying out, and in terms of the definition that has been provided earlier, I would argue that. There is an easier part of the green finance agenda, which is the one that has made the most progress now, particularly on clean energy, on climate mitigation, and so on. And then there is a more difficult one, the more frontier one that we're trying to tackle, which is financing for nature, particularly biodiversity and ecosystem services. And there, I think there is a number of important conceptual and data gaps that, as the World Bank, we are really kind of trying to do our best to help address, including with a new program that I have the privilege of coordinating, which is called GPS, Global Program for Sustainability, where we have a green finance pillar. So why does biodiversity matter in this space? Just to give you a little bit of a sense, the World Economic Forum estimates that there are about 44 trillion of global value added that depend to a less or larger extent on the provision of nature services. So we talk about construction, agriculture, tourism, and so on. And yet, these very important assets are being kind of affected by an unsustainable path of use. Just on the species count, about 60%, a very large number of species is being let's say, affected by practices that lead to extinction and so on. And even more recently, 60% of all human infections have zoonotic origin. So that means that they have to do with the improper way of managing our landscapes. And yet, when we look at the finance, there's very limited finance on the private side that kind of supports biodiversity, and on the government side, there's about $500 billion per year in subsidies that actually encourage unsustainable use of biodiversity and conversion. So there is a big agenda ahead of us all, and including the financial institutions, but also regulators and government to kind of address this challenge. So what we're doing at the bank, we're developing an issue paper ahead of the next meeting of the Biodiversity Convention that was supposed to take place this year, but it's going to be moved now to May next year. And we have this issue paper that will be released in the coming couple of months that draws a distinction. I think it's similar to the one that was discussed earlier, between the financing green, which is, I guess, similar to the notion of impact investment, and green in the finance, which is really to kind of create incentives and provide information so that finance is redirected away from these activities that are detrimental to nature, and redirected in a direction that are more kind of compatible with sustaining these services that are so keen to to the well-being and, in fact, to the productivity of the world. Now, it's not easy. We recognize that. So there is very important conceptual challenges. How close are we getting to so-called tipping points, or points beyond which the ecosystem services, the provision of ecosystem services might collapse? People talk about the conversion of the Amazon into savanna that will have disastrous consequences in all the countries, in all the riparian countries of the Amazon, and so forth. Collapse of fisheries, something that is actually already happening in some parts of the world. But we don't fully understand, how soon this might happen, and what will be the economic ramifications. And similarly, we need to kind of improve the provision of that information, but also make it actionable so that people can use it for informing regulation, informing kind of disclosure, and informing government action with respect to the way that the government kind of allocate their own funds from sovereign bond issues, for instance. So in the paper, we identify, and I know we're pressed for time, so I'm going to try to be brief, five big approaches to, let's say, address these challenges of mobilizing properly finance for biodiversity. The first one is environmental fiscal reform that speaks to what I mentioned earlier, the fact that at this point in time, we have a large amount of subsidies and other incentives that go in the wrong direction. And of course, we need to think about not so much elimination, but repurposing, something similar to what the EU has been doing over the years with its agricultural subsidies. We definitely need to invest more, so that's the second of the big five, into the provision of data, better understanding of biodiversity, ecosystem services, the extent to which for instance, better managed forests contribute to regulating water flows, prevent the siltation of dams, and other things that are very important for our clients in developing countries. There is an initiative already underway which we are supporting, which is the Task Force on Nature-Related Financial Disclosure, which is something that comes following the example of a similar task force for climate-related disclosures, and we feel that this is something very important to the extent that we can inform it with better information, and this can speak to the various actors in the financial field. Something also that was done in the climate field was
You need to keep it a little bit short. We're only down to 3 minutes. Please. Yes,
I'm done.
I
have 2 more to go,
okay,
and then I'm
cool.
done. So the other one is the something similar to the climate space again, the Nature Action 100, which is to identifying the companies that, in this case, don't emit the most, but have the most impacts on biodiversity conservation, work with them to kind of rear-end their practices. And finally, also, we need to work as multilaterals and other in the financial space to provide concessional catalytic funding for the more kind of impact side of things. So let me stop here.
Thank you so much. I mean, I'd love to just hear from both of the ladies. I think one of the things Elizabeth and I talked about earlier is, at least in the European Union, we have taxonomy, but I think the complexity of all of these definitions. But let's ask both of you, if you had an ask or a magic wand, what would you want to happen next? What's missing? What are we not doing right? What can we do better?
Shall I kick off? I think very simply, what gets measured gets managed. And so I fully support the objectives that Raffaello described, but we need to do it in a globally consistent way. Otherwise, we absolutely lose the wood for the trees, to use an ecological example. I mean, we really can't have multiple definitions, multiple taxonomies. So we're very supportive of the EU work, but as a contribution to globally converged frameworks and standards for reporting and disclosure.
Yeah, thank you. Mirjam?
I can only echo that comment that I read in my notes. What gets measured gets managed. Really, one of my favorite quotes. I'm a big fan of the EU regulation. Coming from Switzerland, we're usually not fans of regulations, but I'm a big fan of that one. And I would hope that other economies globally actually adopt similar standards and make sure that we just get this done very fast, because I don't think we have the time to wait until everybody comes on board over the next decades. We can't wait for society to make that change. I think we have to make it a push with regulation now.
This is the thing where I question how total shareholder return and total societal impact can reinforce each other, right? And then the question sort of, will we at some point get to a point where we will have to accept lower market returns? Not sure.
I don't think you will. I think the challenge is the time frame over which you're measuring the market returns. And we have a system that emphasizes shorter term recognition of value creation. And it's almost like intergenerational theft. We're stealing the cost of all those externalities from future generations into our current financial returns. Yeah. If you extended the time period to look at them, then I think you'd find it was on balance the same. It's just the challenge we have on our sort of classic behaviors on reporting.
Wonderful.
Perhaps on that note, you actually see that sustainable investments over the last couple of crises in financial markets performed better than traditional investors. So I believe even greedy investors will look at sustainable investments as a safer, more resilient way of investing, and it will attract a lot of capital, maybe for the wrong reasons, but the money is going to flow into those investments and it's going to be for the benefits of society. So I'm actually quite positive on the risk return side for investors.
Fantastic.
Yeah, we'll tend to agree also. I think on my side, just as it was said before, the trade-off maybe is just illusory in the sense that once we properly, just as it's been done in the climate space with carbon pricing and so on. Emission of CO2 is increasingly affecting the bottom line. So companies and investors will have an incentive to move away. So if we find ways to kind of follow a similar approach when it comes to nature and other forms of environmental assets, then I think we will realign the bottom line to the interests of society at large.
Thank you so very much. It's such a shame, 20 minutes with these incredible people. I wish we had more time. We are at the end of this panel. I appreciate your time so much and wonderful to see you here. And thank you. All the best to you.